Thank you so much, everyone, for joining us this evening, and really happy to have you for this learning session that we've got tonight, which is really an exciting education session on positive income investing. And my name's Elissa, and I work at DPN. I'm one of the leaders at DPN, but I'm really excited to have with us shortly. We're going to have Lloyd, who you can see there, Lloyd Thomas.
Hey, everyone.
Hey, Lloyd. Lloyd is one of our directors at DPN, and he's been working there for, since 1996. He's got over 20 years plus experience in not only investing in property, but in financial services. And he has helped many, many people just like you to get started in property and, importantly, build that passive income, which is what we're going to learn about in this session. So, you know, whether you've never invested before or you've got a portfolio and you're wondering what that next step might be, this is the place for you. So we're really pleased that you can join us. The session tonight will take about 30 minutes, and then there's also some time for questions as well. Now, let me just go to the next one here. Just a little note here. This is an education session. Obviously, it's not financial advice. This is not specific to your individual circumstances. Now, I can see from the people dropping in here that some of you are familiar with DPN and some of you maybe haven't spoken with us before. So it's really important for you to note that DPN is not a builder or a developer. In fact, we're not a marketing front for any development project at all. We actually have an in-house research team that independently researches the market and identifies opportunities for our clients that are investment grade to help them invest in property. And many of you who do know us will know that we also do finance and property management too. So it's important that you know that. Now, if you've ever come to one of our education sessions before, you will know that it is not a DPN session unless you have a quote. And tonight's quote is from Warren Buffett, and he's one of the most successful investors, as we all know. And this quote says, "Never depend on a single income. Make investments to create a second source." And that's exactly what we're going to be learning about from Lloyd in this session, because of course we want to help you to do that and to make, you know, live the life you want ultimately, and have more choice in how much you work and what you're able to do. So now this is a webinar, of course, and it is a little bit interactive. So when we hear from Lloyd in just a second, when I hand over to Lloyd, if you have a question during the session and you just want to ask something, what you can actually do, if you hover over your device, you'll see a little Q&A button or a chat button up there. So feel free to just jump in and ask a question during the session, and I will get to that at the end for you, and Lloyd will be able to answer those questions. So please do that. If you don't want to ask questions, you certainly don't have to, but you're welcome to do that and get as involved as you like. Now, we are going to do a quick poll as well. So I'm just going to launch a little poll. Now, let me see here if we can just launch that there. There's a question coming up on your screen. So you can just, if you can just have a look there, it says, how many people currently have an investment property? Yes, no, or in the process. And this is just going to help Lloyd, I guess, learn a little bit about who's in the room tonight. And so he can sort of work out what he's going to focus on in terms of to tailor it to the audience's needs there. So let's have a look. It looks like everyone's clicking into that. I'm going to end that poll there. See what we've got. Share results. So it looks like we've got 68% of you have got an investment, 11% do not have an investment, and about 21% are in the process or considering doing something. So we'll have a look at the next question there. So, all right, let's have a look. We've got one more question here. Now, this is if you have an investment property. So of those people that have an investment property, is it positively geared? Now, this is a question that sometimes creates a little bit of confusion for people. Yes, no, or don't know. Okay, so have a look there. Now, just going to, still a few people answering. So yes, no, or don't know. Is it positively geared? All right, let's have a look at the results there. Okay, we have got 38% that have a property say it's positively geared. That's great. 46% say no, it's not. And there's another portion, 15%, that don't know, that aren't sure. So hopefully we can clarify some of that for you in this session. All right. So thank you for participating in that. That's great. Now we are going to just pop back to the presentation here. So now I'm going to get stuck in and really, you know, we're going to cover a little bit tonight. We're going to clarify a few things about positive gearing, negative gearing. We're going to, you know, show you some actual results, and we're going to, you know, really, you know, help you learn how to identify the right property as well. But I'm going to hand over to Lloyd now. And Lloyd, so glad that you can join us, and really excited to hear from you. But maybe you can start by just helping us understand what is a true asset.
Yeah, like a true asset is a lot of people think they've got true assets, but one of the things I ask clients all the time, is their house an asset or a liability? And then I ask them another question, and I say, if you took 6 months off of work, what would your house be then? Okay, and for some people, their house is a, you know, I think part of it is an asset because they've got some equity there. And if they sold it, they'd end up with some money in their pocket. But a true asset is something that makes money. True. Well, if you really want to get down to it, whether you're dead or alive, it's still going to make money. You could be in the Bahamas and it's still going to bring you an income and go up in value. So that's what a true asset is.
Okay.
So, yeah, we like to really make sure that people understand what a true asset is. With gearing, gearing is something that you do to, you basically borrow money, as we've got down there. It's to borrow money to invest. The income earned from an investment property is either positively or negatively geared. And so one of the things that I probably relate to in that, with regards to gearing, is that if you think of a push bike, okay, if you want to go up a hill, you change your gears to make it easier to, you know, to use up a hill and make it easier to achieve that. The same thing with gearing when you're borrowing money. You're using other people's money, as OPM, other people's money to actually gear against that particular property to get a return from it. So, yeah.
Yeah, and look, there's often a little bit of confusion. I know that's a question that comes up quite a lot. What is the difference between positive gearing and negative gearing? Do you want to just explain that a little bit?
Sure. Really simply, is a negatively geared property is something that costs you money. And even a lot of people think their property is actually truly, they think it's actually positively geared, but it's really leveraged against their income. And a truly negatively geared property is something that's costing money. So even if you gave up your job and it wasn't leveraging against your income, it's still going to cost you money. And so, yeah, a lot of people, you know, it was the thing to talk about in the past, where it saves you tax and you know, getting a negatively geared property. A lot of people focus on just the capital growth rather than the rental return.
So what you're saying is, if you lose your job and you've got a negatively geared property,
it's going to cost you more.
There that you've got to actually fund to hold that property.
Correct, and so you're leveraging against your income and claiming some tax against that.
Okay, let's look at what's positively geared in contrast, if you wouldn't mind.
Yeah, sure. A positively geared property, like I said before, it's a true asset. It actually can make you money if you go to the Bahamas for 12 months, don't earn any income in Australia, and have a great holiday somewhere. At the moment, it's probably a little bit harder than normal, but it is something that actually makes you money while you sleep. And it's not leveraged just purely against your income. Although you still get some tax deductibility from there. You know, you talk to your accountant about how that works, but the big thing about positively geared is it is a cash earner for you.
And is that before tax or after tax, or both, Lloyd?
Both.
Mm-hmm.
Yeah, so it can actually be positively geared before even leveraging against your tax.
Okay, sounds good. Maybe we can share a little bit of an example here, just
Sure.
how that works and what sort of, what does someone need to do this, if you can break that down.
Yeah, so if you look at the example we've got there, this is actually using some equity out of someone's home. So what that means is, if you've got I'll give you just a quick verbal example. If you've got a property that's worth, let's say, $1 million, you owe 500,000 on it, you've actually got $500,000 worth of equity there. And so what you can do, depending on your income, you can usually draw some equity out of that particular property, of your family home or another property you may have. And so you use the equity out of that to actually borrow. Some people borrow 10%, 20%, but if you did that, if you used a 20% deposit out of a current property, use the equity out of there, you could buy a property like this, as we've used as an example. And this one's a 4-bedroom and a 2-bedroom dual key. So it's a dual income property, which means you're earning 2 incomes from it. 690,000. Your initial investment, just as a deposit, would be $1,000. Your purchase cost, which consists of stamp duty, and on this particular one, we're saying that it's not constructed. So you're buying land first, and then building a property on it. So you're only paying stamp duty on the actual land value, and you're paying some solicitors' fees there as well. So your loan amounts are in about the $700,000 mark at the 3.5% interest rate. Your rental yields are around about 5.3%, but on a taxable income of $80,000, you're actually going to be positively geared on that, because you've got some loan costs, you've got some interest payments and things like that are all going to come out. And with your rent coming out at $720, you're going to be positively geared on that property. Even before tax, you'd be positively geared, but you're going to be around about $9,300 positively geared on that a year. And you're going to get a tax rebate back of $4,200. Okay, just on that example there. Yeah. Now, you're borrowing the whole amount in that scenario there.
Yeah, because of course you hear some people talk about positively geared properties, but they've put in a massive deposit. So if you have a big enough deposit, anything can be positively geared. But when you're putting in, in this example here, it's still stacking up with a very low investment.
Yeah.
To get going.
Yeah, it's actually working for you. And the thing with this kind of scenario is it's one of the things that we commonly use here at DPN to help people pay off their own personal debt. And so it helps reduce your own home loan, because you're bringing in extra income now from an asset that is helping add more payments to your home loan, which obviously reduces that time.
I guess you're also getting the capital growth on top of that as well.
That's correct. Yep, yeah. You're getting the capital growth as well.
Great. All right. So what if you don't have equity? Because, you've only got equity, I suppose, if you've got an existing property. You might have a home with a mortgage, or maybe a different investment already. But what if you don't have equity as an option, Lloyd? What does that look like?
Look, there's different ways of tackling this. There's even things, that we can actually do with, if you've got a parent that's willing to lend some equity out of a family home, and we can do a sort of like a family pledge. Obviously, that's a different thing to talk about as well. But the big thing is, if you've got a deposit, obviously you could buy something. If we use that same scenario, same property, but we actually inject a deposit of $85,000 into it, you'll see there on $80,000 income, it increases that rental or that income per year now to $11,000. So that's making a huge difference. All the deductions are the same. Obviously, the loan is less, because you're only you're borrowing $616,000 against the $700,000 before. But this is a great way for young people to actually sort of leverage into the property market, because they're sort of thinking, oh, how do I buy my own family home, or how do I do I have to buy an apartment? One of the things that we sit down and go through with people all the time is making sure that you get a land content. That land is such an important thing when you're buying the right property, and making sure you do your investigations and research on those particular areas as well. But as you can see, it's $11,000 positively geared now.
Yeah, absolutely. And I guess when you get a couple of those, you start to build that passive income.
Correct.
Which is a great thing. So look, on this slide here, we've got a couple of key ingredients for a positive income strategy. What does that
Yeah.
look like?
Well, I think, like as number one, it says their property type. It's really choosing the correct property that's going to generate that higher return. And one of the things that I'll just put in there straight away is, the property type doesn't mean, going to a mining town, or, I guess that's a bit of location that we could go into number two with, but we've never done mining towns. What we're doing is actually choosing a property that's actually going to give you a really good return. So it'll be a dual key, which is, consists of either a 4-bedroom side and a 2-bedroom side, or a 4 and a 3, or a 3 and a 2. There's
kind
a
of
different
like and granny flat type thing.
Yeah, that's exactly right. Yeah, so there's different configurations, and we've got some examples of those later. But so the key is making sure that you choose the right property that's going to generate that high return. Then, as you see, is number two there, getting high growth. And, it's like having your cake and eating it too. It really is a great design in getting a property that's going to give you a great rental yield, but also a great growth rate as well. Okay, so we've got to really make sure that we find those particular areas. And then, considering your interest rate, I mean, look at interest rates these days. They're lower than they've ever been before, and returns for people, in cash and literally on a weekly basis now is like it's never been before. And in fact, someone asked me the other day, how's this the circumstances and the situation that we're in at the moment with Australia and affecting rentals. And with the rental yield side of things, we've actually seen massive increases in the areas that we've put people into, and up to $100 more a week in rent than what we anticipated for the client. And so rental yield's really important, but it's actually getting down and understanding, okay, what's the vacancy rate before you buy in there? Because you don't want to buy into an area that's got a high vacancy rate, even though it might promise a great return. They're the things you need to consider in everyone's individual circumstances.
Mm-hmm. Yeah, no, that sounds really good. Some 4 good principles there to look at. Now, I think, one of the things here, if you want to talk a little bit more about location and just how to identify what people should look for, or what I suppose the process is to kind of find,
sure,
a property that is investment grade. And
yeah.
I guess half about it is what you're not accepting in this process.
Yeah, I think planning is a real key thing here. And, one of the things, like it says there on the screen, we really focus on major cities or regional hubs. And what we mean by regional hubs is something that's growing. It's not just, going out to the back of Whoop Whoop to buy something because it's cheap, and I've had clients over the years come in and see me and they said, oh, look, I can get something for $120,000 and it's getting $160 a week rent. And they think that's a good deal, but there's actually no growth in those particular areas that they were looking at. And so what we need to make sure is there's 2 things that we really look for in major cities and regional areas. 2 things are that there's population growth and income growth. There's got to be jobs in those areas to sustain the people moving in there, okay? The second thing is really narrowing it down to growth suburbs. Not every suburb is going to have the same growth. A lot of people say, oh, they refer to the Australian property market. Well, there's more than one Australian property market. Every individual suburb is an individual property market. And so that really can make a difference in finding those right areas. And there's an area down south of Wollongong that we've put many people into, that it's been a great performer for us. And right next door, that's sitting at around about 9% predicted growth for the next 5 years. But right next door, there's another suburb that's sitting around about the 3%. And so it really is a real focus for us to find those particular growth areas. Obviously, affordability, not just for the person buying the property, but the person that's actually going to rent it. And so it's one of the things that we consider. Okay, who would rent this, and what would they be willing to pay for it for a week's rent there? And so we make sure that there's income and like I said, and job security in those particular areas, and also having a land content like I talked about before, and getting something new, which you obviously, as it says there, enjoy tax benefits and less maintenance and all those type of things or advantages that come with a new property.
Yeah, so it's really good to go through that, because thank you, Lloyd, because it's not just a case of choosing a certain property type or a certain suburb. There is a lot more to it, and there's a number of key factors to really make sure you're looking at a number of things to identify that right property in that right place. And that's a really good methodology there that you've shared. Now, let's talk a little bit about leveraging. Now, you did mention this a little bit before, but let's talk about that.
Yeah, sure. Well, leveraging, I mean, look, leveraging can come in different ways. Obviously, like I talked about before, is borrowing other people's money. So obviously the banks, and there's different ways you can leverage, even through a property and through the loans and that type of thing you can actually get. And so, like I talked and alluded to before, is even ways you can leverage off your parents' property or a family member's property to get into it. But you know, as it says here, a positive income property influences your borrowing capacity. And so one of the things that I always say to people is, and especially people on the, you know, that are starting their journey in property investment, is be really careful about what you buy first, because it actually either helps you or hinders you move into the second one. All right, because if you're getting minimal amounts of rent and you're getting a you know, minimal amounts of growth as well, it's going to really prevent you moving quickly into a second property or having that ability to do that. And so you know, getting a strong growth property with a strong rental return is going to be a real advantage to affording another property down the track.
Yeah, that's really good advice. What would you consider as a strong rental yield or a strong growth? What would be sort of a bit of a benchmark that you would?
Yeah, I think 5 to 7%. I mean, some of our clients in some areas at the moment, they're getting, you know, well over 6% returns on their property investment, and it's an exciting
rental
thing.
yield or
rental yield, sorry,
yeah.
Rental yield, and you know, and we've got some examples that we're going to show in a second. That you know, some of these properties are in 9% growth areas, so you're not just getting a really good rental yield, you know, because they're borrowing the money at, you know, early threes, and you know, they're renting it out and getting a 6% return. So they're sort of, you know, doubling the yield on it when you think of it. And so that extra cash can either go into reducing that debt. So if it's their first property and first investment, we show them strategies on how to reduce the debt on those particular properties. Or if they've got their own house and their own owner-occupied home, obviously they want to get rid of the debt as quick as possible on that. So we show them how that can actually help that and accelerate that, you know, getting rid of that loan as quick as possible.
Okay, great. All right, now let's have a look here. Look, we have another quote, and the previous one was from Warren Buffett. This one is from John Stuart Mill, and if anybody knows who this man is, I reckon you deserve a prize, because he's a bit more unusual, but he is a philosopher, and he's a philosopher among a number of things, actually. But one of the things that he said was that landlords grow rich in their sleep. And I think that sounds wonderful.
I would put in brackets at the end of that, if they've got the right property. So,
yeah, because it could keep you up,
yeah,
or it could, you know, you could be going, oh great, I'm earning money while I'm sleeping, which sounds wonderful. And I'm sure that we all want to know about that. Maybe it might be good to actually talk through a couple of examples, so we can see, you know, actual real life things here, and make it a bit more, you know, tangible. So let's maybe if you can take us through this one. Now, this is a duplex.
Yep, this is a client of ours that bought a duplex, finished late last year, early this year, and now it's actually strated. It's two complete full 4-bedroom properties, and like it says there, he paid $783,000 for that one. And yeah, it's been a really good 18 months, because he's picked up $140,000 or $130,000 in, you know, 18 months or so, which is a pretty good return. And that's obviously the bank valuation. And at this particular time, banks are quite conservative as well. So we know valuers are as well. So and so, yeah, if you look at that, it's a 5.6% rental yield, and but, you know, manufactured equity of $127,000, which is a pretty good return, and on your first investment, and it's at least, and I say at least 19.3%. Sorry, $19,300 a year in positively geared cash flow. because with what I've shown that particular client is, okay, with your pay and your savings, put it in an offset account.
Yep.
And so he's earning well over $20,000 a year out of that particular property.
Yeah, and that's great. And look, the structure can be so important. And that picture is only half the property, of course, because it's a duplex and it's got two identical sides. So you can see one half there, and then you can see part of the backyard in the other picture there. So, you know, look, that looks, and you know, you mentioned it's a duplex, so it's strata titled. So I'm assuming you're referring there to a property that can be, either side can be sold separately.
That's correct.
Strata titled.
Yeah, so they can be sold individually. You know, when you need to sell one, you can. And obviously there's a strategy behind when to sell and when's the best time to keep and how long for, and that we can go through with the individuals as well.
Okay, fantastic. Now this one's another example. It's a dual income, so different to a duplex. How does that differ?
Yeah, so that one's actually a 4-bedroom on one side and a 1-bedroom on the other. And so yeah, when I sat down with the clients and showed them this one as an option for themselves, I actually told them they'll probably get around about, I worked out all their figures on $660 to $680 a week in rent. But as you can see there, they're getting $730 a week in rent, which is a pretty good rental yield. And they've made around about $90,000 within the first, it was less than 12 months actually out of that particular property. So they've done quite well out of it. It's actually had really good growth. It's right up near the hospital up there at the Sunshine Coast. So that one's worked out really well. And obviously, as you can see there, it's around about $13,000, just under $14,000 positively geared.
Okay. And this one being a dual income, you can't sell each side separately.
Correct.
It's one title of land. Now, when you say it was 13.8 positively geared, do you know what sort of deposit this particular example had?
That one had no deposit.
Mm-hmm. Okay.
So there was no deposit on that at all. That was using equity out of another property that they bought off me.
Right. So if they had a deposit, it'd be, you know, even more.
Yeah.
Great. Okay, let's see what's next. Another dual income home. Let's talk us through this one.
Yeah. So this was another client of ours that came and saw me, had a little bit of savings, and we showed him some strategies on how to get into a property. $628,000. That's a really good area where he bought in that particular area. There's no more land left up in there, and he's probably made some pretty good gains. We haven't done a valuation on it yet, but I'd say he's made some money on that straight away as well. But he's getting $790 a week combined income. And I worked out all his figures on just on around about the 690 to 700, and just this has only just been recently rented, and he got $100 more than we worked out his figures on. And so as you can see, it's over $15,000 a year positively geared. It's a pretty good rental yield at 6.5%.
And just out of interest, how long are you finding it's taking? Would you like to share, you know, the time it's taking to rent?
Okay, yeah, that's actually on this one, it was pretty remarkable. He rented out one side in 2 hours, the other side in 20 minutes.
Oh, okay.
So, yeah, it was absolutely incredible. And he rang me, he was there with his parents and rang me quite excited from the property and said, hey, look, I'm here at the property visiting, and we've already rented it out, I've been told. And we're renting it out. And it was rented out before it was actually even handed over officially.
Okay, yeah. And is that a common story for a lot of the clients here? A lot of your clients, Lloyd?
Yeah, we're finding it really consistent with the areas that we've put people into. Even, you know, that one's up north. Even one we rented out the other day was $60 more than what the client was actually expecting on a weekly basis. And that rented out straight away in one day. So we're finding in these particular areas, there's been a lot of research that we did originally before this property even started being built on what was coming up and what the area was showing as vacancies and what was the vacancy rate for that particular area before even, you know, signed a contract. Yeah,
which is fantastic. I mean, considering there's been a lot of movement from rentals, particularly in units in the CBD.
Yeah, it's been terrible.
You know, it really, I guess, is testament to the research that where the demand is, which is great. Now there's, I think, one or two more examples here. This one is a duplex.
Yep, it's another duplex, 4x4 duplex. That particular property, the land settled on that on the 19th of September last year, and it was completed and the tenants, it was all rented out, completed and everything like that by the end of June this year. And so it was a pretty good turnaround. And as you can see, manufactured equity is $153,000. And within a less than a 12-month period is a pretty outstanding result, especially with a 6.4% return on that as well.
So with something like that, if that person wanted to, look at another property with that manufactured equity, are they able to, how quickly can they look at that second?
Yeah, well, that's exactly what this is. A young couple who bought this rather than buy their own place or their own home. They decided to go down this route. Some of their friends actually went out and bought apartments and units, and they definitely haven't made $153,000 in the last 12 months out of those. But this one was a young couple, and now they're saving like crazy because they can see the benefits of what's happened here. And by the end of next year, they want their second one. So off they go again.
Good news story. Okay, and I think this might be our last example, but this one is a dual income, and this one's in Queensland.
Sure. Yep, again, 3-bedroom and a 2-bedroom. This one was actually bought by a client in their self-managed super. And so it was a completed property. And so, yeah, there was a deposit paid on this one. And but as you can see, it's a pretty good return, $630 combined weekly rent. So and with the the deposit, obviously they had to put some in. And but the thing to remember on this too, with self-managed super loans, your interest rates are in the high 5s, and so so we're not talking low 3s for a normal housing loan. And but you still got the benefit of getting 2 incomes and good growth out of those particular properties as well if you buy them in the right area.
Right. Okay. Fantastic. All right. So in terms of a positive income strategy, and you're mentioning a lot of these clients getting a second property or another property. Do you want to just talk us through the portfolio approach and why that's important and why do you want to do that?
And look, one of the things when we sit down and we do a strategy for people, it is not just usually sitting there and talking about one particular property. It's actually a process that we take people on a journey through. And, and so if you bought property, and look, we've just summed it up by averaging it out at, $15,000 positively geared for a particular property. And if you bought one, as you can see, you're $15,000 positively geared a year, where if you look at a second one, and that could come within the next 18 months to 3 years, depending on the person's situation. I've had clients that have come and sat down and we've gone and put a strategy together, but they're obviously quite well off and had done no investments before. And I've had one client that bought 5 in a month and a half, and another one bought 6, and so they're very, very strongly positively geared on those particular properties and making a really good return. But in this scenario here, it may take a little bit of a time depending on the person's circumstances. But you could have a property portfolio of just under 1.3, and it's going to get at least $30,000 in cash flow a year, and that's after all expenses as well. And then taking it to the next one, you're looking at a $45,000 income there for a $1.9 million property portfolio with 3 properties. But remembering that they would either be a combination of either duplexes or they'd be a dual key kind of property. So we might have 3 properties there, but there's actually 6 tenants that we're getting a reward from. And so, so it's just not one property, one tenant. It's actually 1 property with 2 tenants.
Sure. And I guess, if people were doing a standard home, the types of, return that they could expect would differ, and it would be less. Have you got any indication of what a standard home might look like?
Look, I was talking to someone the other day, and they were looking at a property just to purchase themselves, done their own little bit of research and everything like that. And it was just under the $500,000 mark. And in the area that they were talking about, it had 3% growth. I did a bit of research for them, had 3% growth, and The rent that they thought they'd get would be just over 400. I actually think it was probably going to be a little bit under that. So, you know, let's call it $500,000. You're going to get $400 a week rent. That property, even with today's interest rates, is maybe around about, depending on, you know, the individual's income, and if they were going to put a deposit into it or not. But you know, let's say it was no deposit. They just put $1,000 down, used equity out of their own property. They're going to probably be between about 25 and, you know, 35, maybe $40 a week, positively geared at the most.
Yeah.
And so it's virtually nothing. And if let's say they took a year off and went overseas and holidayed, or didn't work for a year and didn't have an income to leverage against, that property would be considerably negatively geared, because they'd have no tax return, no tax rebate from that.
Okay, so that's interesting.
Big difference.
So what I'm hearing is that you're looking for high growth, low vacancy, and high rental yield. It's that trifecta. Let's flick to the next slide here. So I think, you know, that sort of concludes the formal part of the presentation. We will be asking anyone to jump in with some questions. I can see there's a few questions coming in. So feel free to do that. But, you know, I suppose, you know, the interesting thing here is, Lloyd, that you've mentioned that, you know, what's really important is we do a strategy before you invest, so that you can see really clearly what you're going to do before you do anything.
Yeah, that's true.
What the returns are going to be, what the costs are going to be, what the vacancy rates, the growth rates, everything. The research is there before you jump in. So Correct. You know what you're getting yourselves into. I think that's really important. And using research is the key, which is really good. Making sure that the right structures are in place, and really having that team there to concierge that service, make it easy for people that are busy, you know, with their life, and that's what DPN is there to do. And of course, managing your property with tenants, but also that ongoing portfolio review. So I think we're going to jump into questions in a minute, but if you have listened tonight and think, you know what, I do want some help with that, or I'm considering something and I want to check if I'm on the right track, I encourage you to have a chat, or if you want a strategy for yourself or a portfolio review, get in touch with the team and just simply email hello@dpn.com.au or send me a message in the chat, and one of our team will get in touch with you and be able to help you out and just make sure that, you know, you are looking at the right things and get you started and on track to building that passive income. I'm going to jump to some questions, Lloyd.
Sure.
So a couple of quick questions here that have come in. One person is wondering, they've got about $10,000 saved. They're earning about 120K, and they actually are wondering what they can do to speed up the process to getting that deposit together. They don't have any other property.
Sure. Okay. So yeah, look, that's a common thing where we have people come in and they go, look, I've got great incomes, but I just haven't had time. They might have just, you know, moved into into a new employment and, you know, into a new job, and sort of thinking, okay, how can I gather that the deposit as quick as possible? Look, the old savings process is one option, obviously, but that does take a little bit of time. But this is where I sort of alluded to before, where there is different ways depending on people's personal circumstances. If you've got a parent or a family member that has a good amount of equity in the property, and that's something we can actually sit down with, obviously the particular client, and also talk to the parents as well. We can actually show them how they can get a family pledge or an equity release loan. And so they're wholly and solely responsible for it, unless for that particular loan. And so it's only assessed on their income. But that's one really good way of getting into the market as quick as possible. And, you know, obviously there's some things we have to go through, and conditions and all that kind of thing. If everything went belly up, you know, what would happen? What's your worst case scenario? And we'd go through that. But it is a very, very safe way, specifically with the way that we actually, or the way our properties actually work, to helping people get into the market a lot quicker.
Yeah, just on that worst case scenario, we have another question here with someone wanting to understand, examples of the worst case scenario, maybe how long it might take to rent, what happens if it takes a long time to rent, if there's anything there.
Sure.
Or how it might continue to grow over time despite a slow start. So could you answer something first about rent?
Yep. Okay.
And then growth.
Yeah, sure. So one of the things, I mean, if people buy through DPN, we have what we call our rental assurance program. And basically it just covers people if the properties are unrented for 6 weeks or more. Once it's completed, then we have an agreement with them that will actually pay up to 92% of what we said the rent was going to be. And so that gives them that assurity that they will get a return from that particular property, that it's not going to be something that sits there. And look, that is something that we very, very rarely ever have to pay out on, and it's and it comes out of our pocket, so it's not like something that we sort of anticipate at all. That's why our research is so important to what we do. We don't want to put people into property areas that we think, oh wow, you're going to be a long time without a tenant. We want to get that turnover really quickly, get someone in there. And like I said before, when you asked that question, Elissa, regarding how quick do we get people into them, majority of our properties, and I'm not just saying it, it's actually factual, that majority of our properties are rented out before they're even completed. And pretty much every single one of those duplexes that we were looking at just then, and the one in Aberglasslyn that was completed and bought last year, that was actually rented out before it was even able to be moved into. And that's probably one of our latest ones that we've done. And it's and we've even rented out some stuff this week that's not even completed. And so so it's one of those things we look at.
Having those good relationships with the builders, with our property managers and the builders, being able to get in and know the areas really well is important.
Correct.
But I think some people wonder or worry that rental guarantees are put on top of the price. So how would you sort of explain or answer that?
The price is the price from the builder and the developer. There's no margin, as in we don't buy the land at this and sell it at that. You can buy the land directly from the developer yourself at the same price. And so the actual rental guarantee is just a guarantee that we've put together purely to create that assurance for our clients, saying, hey, we've done the research and we're willing to back it with our own money.
Yeah, and that's really important. So we're facilitating the sale, but the contracts are directly with the builder and
Correct.
Developer. We don't have control over their price. We're not adding anything to their price, which is good. Another question here is around location and what areas are really hot right now that you're finding.
Yeah, look, that's probably the most important question, isn't it? Look, there's many different areas at the moment, and it really gets down to price point. I've got some stuff down south, and around the down near Wollongong, down past Wollongong. There's some really good stock down that way. We've got some stuff. I think the place has been the gift that keeps on giving is up near Newcastle and around those surrounding areas, and we can get people into that sort of place for around about just over the $600,000 mark for a dual key. That's going to give them like the example that we used there tonight. It's going to give them a return of around about the $10,000 a year as a minimum. And so so there's some of the areas, and obviously some southwest as well. I think southwest is going to be a really good area, and there's some new land that I was talking to a developer today about some new land that he's just bought and down the southwest there, and we've just found we're getting great returns and good growth in those particular areas as well.
Yeah, and one of the questions is around do we have properties in other states or what states?
Correct. Yeah, we do. Yeah, and but look, there's some of the areas that I would say you need to really do your research on that, and so there's only a particular few suburbs and areas that I would put people into, in places like Queensland. I think there's some areas there that could be quite a challenge for people to get tenants later on down the track. But in the right areas, I think you can make a really good return on that type of stuff. Yeah. And Melbourne's probably a little bit, down in Victoria, is probably a little bit harder to do, obviously with the dual keys. And that type of process that we do, which is quite convenient and simple up here in Sydney and in some of the areas in Queensland. So yeah, but to answer the question, yes, we do other states as well.
Great. Now we've got quite a few questions coming in here. One person's asked, how many properties do you have personally as investments? And I guess they're probably trying to wonder, do the people at DPN invest in the properties that we're suggesting for other people?
Look, I've put my family members in it. You know, I've got property, and I know Elissa, you have got property as well, and so you've made quite good gains out of your properties over the years that you've worked with us. And even another staff member bought a property this week off me, and so I sat down, did a strategy with her and her husband, and they bought a duplex, and so, which is really exciting, and they'll gain some really good gains out of that. So I've put my kids into our properties that we do, so it's not just a theory process, it really is something we use.
Oh, that's good. And I think, just to add to that, I think that's what makes it so joyful, and that's why we enjoy doing these presentations.
I love it.
Because we really enjoy helping other people to get started or to learn something new that they may not have known before. And we're already aware of those benefits. Another question here, how can I best invest with my self-managed super?
Sure. Look, we can't specifically go into the self-managed super side of things, and that's where you need to see a financial planner about that. And but from a property side, we can actually help you facilitate the property and the finance, and we're willing to sit down and have it, have a chat to people about how that can actually be facilitated. And also we can link you up with a financial planner that can actually go through the self-managed super structure and see whether that's a benefit for the individual.
Okay, how do you decide which type of property, such as a dual key or duplex, to build in the areas you select? Is there a certain indicator that makes one property type better than the other?
Absolutely. It gets down to price and affordability. If a client can afford a duplex, I'll put them into a duplex, because the what we talked about before was the manufactured equity. And there's some really good returns that we've had over the years and consistently having. When people buy a duplex, they get that upside of, the property they're buying on one block of land increases in price, because then you have two individual properties that can be sold individually.
And also it may depend on the block shape as well as to what may, actually be allowed there in the particular council as well. But great question. Thank you, Dan. Okay. One of the people here is currently in the process of building our first DPN property. If there is instant equity upon completion, is it better to sell, pay down our home loan and go again, or should we hold? Our main goal is pay our home loan down as quickly as possible and then develop a property portfolio. We already have a commercial property which is positively geared at about 40K per year. Great question, and a really common one as well.
Yeah, look, one of the things you've got to be aware of, if you build a property and you sell it within 5 years, you can be hit with GST, not just capital gains tax. And so these are the things that you need to consider on the way through. So that's the sort of thing we sit down, we help people work out on an individual basis. But, I'm working with a couple at the moment that they've had their property, it's just coming up to 5 years. They bought it from me at $472,000. And we just did a valuation just recently on it, and it came in at 780. And so I think they'll probably get just over 800 for it once they sell it. Their home loan's at $350,000. So what we're going to do, we're going to sell that. That's their first property they bought off me. They bought another one a couple of years ago as well. So they've got two investment properties. Both of them are positively geared, but the first one that we're going to sell is only a 4-bedroom. It's not a dual key. And so they got $350 owing on their house. We'll sell that first property. They'll walk away with around about $300,000, pay around about $60,000 at least in capital gains tax. And so, they'll be left with around about $240,000 that they can take off their loan, off their house, which leaves them about $110,000. And so it's actually reducing their time of paying off their home from over 20 years. that they thought they were going to take to the, they'll have it done in 4 years. And so that's one of the things that we sit down and we work out individual strategies on that, on when to sell, why to sell, how it's going to affect you. Is it a good time to sell? And every single person has a different circumstance. So we've got to really make sure that we work it to make it a real advantage. And it could be meaning you actually don't settle on one financial year, settle in the next financial year. So we can get very specific on when to actually sell that particular property.
Yeah, so thank you, Belinda. Great question, but it may be that you need to have a further chat with your person at DPN that you're working with, or reach out to any of the team here. We will assist. Now, next question. Still confused between, as a first-time investor, go big, pay 100K more for a dual key, or start small in same location by constructing a single dwelling?
Yeah, good question again. Look, if you can afford the extra money, I would go to the dual key because it is so cash flow positive for you. And that's where it's going to give you that return that you're just not going to get out of a 4-bedder. And, so it might be a 4-bedroom or 3-bedroom compared to a 4-bedroom and a 2-bedroom. You're just going to get that little extra bit of return out of it. And it's going to give you that cash flow. And yeah, I find that I've got some of my clients, actually, I spoke to one of them yesterday. They're selling a couple of their properties that they bought probably close to, I'd say probably 8 years ago off me. And they are just about to sell those because they're a 4-bedroom home. And they've got several of the dual keys as well. And they just said, oh, look, we just want to replace our portfolio now with all dual keys or duplexes, because of the return that's coming off those in cash flow every year.
Yeah, fair enough. Good point. Okay, next question here is from Sharon. Is DPN purely residential, or do you do commercial as well?
Mainly residential. And we'll probably stay with that because of what's going on at the moment in the, some of the commercial side is really, really good still. Other, as you know, with businesses and the challenges that some people have gone through at the moment, that's probably not something we'd go into at this stage. But we have done some commercial over the years, but we've really basically focused on the residential side because everyone needs somewhere to live. That's the thing we found.
Yeah. Yep. Okay, great. Okay, now we've got a question here. We're based in Melbourne. Do you only buy interstate real estate? So I guess from your perspective, you're wondering, do you have to buy outside of Victoria? Is probably your question.
Sure. No, we have, like I said before, we have Victorian properties and we've got some really good areas down that way. But again, they would probably be not dual key or duplexes. They would be just a 4-bedroom house and land package or something like that, but in a good strong growth area. But it's the dual key if you want something like that with a really good yield. Victoria is probably a little bit soft at the moment on yield as well, and so the rental return, where you're going to get something a lot stronger by buying a dual key in one of the other states that I mentioned before.
And do you just want to explain, is there a reason why you can't do the dual income or duplex down there easily?
Yeah, just council requirements and a lot of it needs to be in DAs, and when the actual subdivision goes in, it needs to be approved for those dual income properties before they actually get, so that needs to have an allotment of sites before they actually get approved. And so, yeah, there's a bit more. Nothing's absolute down there, so it's been a really hard area or hard place for us to get the duals in there. We've done a couple over the years, but not a lot down there. It's quite a challenging process.
Mm-hmm. Okay, next question. Other thing, as a seller, are we reducing the number of people who would buy a dual key versus selling a single dwelling? So in other words,
yeah, great
if you
question.
go to
What resale?
A dual key, who would buy it? Yep. And are you better off selling a single home? Which is going to do better?
Sure, that's a great question, and I've got a great story that has only just recently happened last couple of months ago. And I had one of my clients, and he wanted to upgrade their own home, and we got him a property a few years ago. and he was getting, he paid 620,000 for it, getting 850 a week rent. So it was very strongly cash flowed. And anyway, he rang me, he said, look, I'm thinking of selling. What do you think we could get for it? And one of the local agents I knew quite well in that particular area, he said, look, I think they'd get between 790 and 820. And anyway, the client was actually quite keen to get it moved.
Mm-hmm.
It's sold in one open house. They didn't even advertise. He just, the actual real estate agent did a bit of phoning around just to clients that he knew that were looking for properties. And the couple that bought it are going to live in one side and put their parents in the other side. Yeah. So it didn't, there was no advertising. There was purely a phone call that actually sold that particular property. And the open house, I think, was at 9:30 in the morning. The actual agent rang me at 10:15 and said, hey, I got some good news for you. And I thought he was just going to say, we had a good amount of people turn up to the open house. And he said, no, it's actually sold. And so,
fantastic.
Yeah.
And look, I guess, anybody that's looking to have an income producing home, renting out one side, or having, teenagers in one side, or older parents in one side, it provides those options.
Yeah, it's great.
For people. So it's definitely got some popularity and some purpose there. Now I've got a couple more questions here to get through. So
we might do two more and then wrap up.
Two more, yep. What about development in Auckland, New Zealand? Under unitary plan, you can now build 6 townhouses instead of one old house on 700 square metres.
Sure. I was only approached the other day through a mate of mine who is he's a Kiwi, and he runs a lending organisation, and he was talking to me about a similar thing and saying, hey, look, we should get DPN over there. So it's something that we're looking at, but I'm not up to speed on it. So I really couldn't say, yes, that's what I've heard or anything like that. I know that it's something that when we've got time, we may investigate that as well.
Okay, now we've got time for just maybe 2 more questions. I think this one's really important, so I do want to cover this one. And for anyone we don't get to, we will reply to you personally. Now, this question here is, could you please indicate what is your charge for your service?
Yeah, sure. Because we're a real estate agency, we actually get paid like a normal real estate agent. And so we have an agency agreement with the landholder or the developer, and then we get a fee, just like if you went and bought it from the developer yourself. The salesperson would obviously get paid a commission on that. That's how we get paid. The other thing too, we're actually a licensed broker as well. And so we get paid from the bank. And so if you do a finance through us, we get paid from the bank directly. And then the third way we actually earn an income as well is through our rental management. If people decide to go with us, obviously they get that rental assurance program, and also we look after the rents, and we get great reviews from our team that looks after the rental side of things. They're a fantastic team. We've got a team of 8 women, and they do a sensational job and constantly get great reviews from tenants as well as landlords.
Yes, you can see those reviews on Facebook. So really important there, the strategy service and the portfolio review service is complimentary. Sure. Only if you purchase a property will DPN receive a commission from the vendor, which is usually the builder. There is no fee for you to pay directly for that service. If you use a loan, if you get a loan through the DPN team, the bank will pay a commission there, and there is a fee to use the property management service. Okay, so hopefully that answers your question there. And the last question that we've got time for tonight is, what sort of appliances are you installing into properties you're offering? Aircon, ovens, dishwashers, hot water systems, gas, instantaneous, brands or fixtures? Is it still positively geared off the dual rate costs and insurance, after all of the costs and insurance? This is probably more of a case of a specific question, but it is my first 5 years in my first property based on paying interest only or principal and interest. So I think they're trying to ask what's included. Is everything included?
Everything's included. Yeah, so it's a turnkey thing. So it's basically for a tenant to move in with their furniture and their clothes, pretty much, and a fridge. The only thing we don't supply is a fridge, and but pretty much everything else is in there, you know, even automatic control on garage doors, things like that. And so you just move in, the tenant actually moves in, and in pretty much all of our dual keys at the moment are positively geared, and that's including all the rates, the insurances, every single thing is included in that, and even pre-tax cash flow. And this is a real key thing to look at when you're looking at a property that is technically what people are calling positively geared. You look at the pre-tax cash flow. So before you get your tax deductions, is it still positively geared? And that's one of the things that we really look at as well.
Fantastic. Well, thank you so much. There's been so many questions, and I apologize we haven't got to
thanks,
every
everyone.
single
It's great.
person tonight. Thank you, Lloyd, so much for your insights
My
and
pleasure.
sharing your experience with us all tonight. And I just encourage you all, if you would like to get in touch with our team and get a strategy done or have that portfolio review, whatever you need, let's open that conversation. hello@dpn.com.au. We look forward to hearing from you, and we hope you've enjoyed the session today. Thanks again.
Well done, Elissa. Thank you. Bye-bye.